On behalf of the organizing committee, I welcome everyone to the Investing Opportunities in India conference hosted by DoorDarshi Advisors. It is my pleasure to welcome you all. I invite Mr. Rajeev Agrawal, founder of DoorDarshi Advisors, to kick off the proceedings. Rajeev Agrawal is the fund manager and managing partner of DoorDarshi India Fund. DoorDarshi India Fund is a US domiciled hedge fund that enables global investors to benefit from opportunities in the Indian equities. Rajeev is also the founder of DoorDarshi Advisors, a general partner to DoorDarshi India Fund. Rajeev has been investing in the US and Indian equity markets for 20 plus years. Prior to starting DoorDarshi, Rajeev was a technology executive focusing on the financial industry. He has worked with Goldman Sachs, Bank of America, and JP Morgan. He retired from S&P Global as a managing director. Rajeev did his BTech from IIT Bombay and MBA from IIM Calcutta. Rajeev is also a CFA charter holder. I welcome Rajeev on the stage.
All right, welcome everybody. It's so wonderful to have you all here for the first India conference in Omaha. It has been something that I've been dreaming about. I've been coming to Omaha for almost since 2017. And I was like, okay, we don't have a place where if you want to discuss about Indian investing, we can go to. So it's such a pleasure that we have been able to organize this. As Shuchi mentioned, it is organized by DoorDarshi Advisors, but it is supported by DoorDarshi India Fund, which is something that I run and will talk about it. We also have Mukund and we have Alok Gupta from BDL who are supporting us in organizing this conference. And then we also have ICICI Bank represented by Akshay and Neeraj and Arul who are here supporting this conference. And this is what is enabling us to organize this conference. So we want to thank all the sponsors for having this conference. So the genesis of this conference actually was born last year. Many of you would know last year I was lucky to ask Warren Buffett a question on India. And I will just play that for you. Dear Warren, Greg, and Rajeev, thank you for having us. Your teachings have not only made us better investors, but more importantly, better people. Thank you for that. My name is Rajeev Agrawal, and I am from New Jersey. I run an India-focused fund called DoorDarshi India Fund. My question is related to India. Indian economy and Indian equities have done quite well in the last 5, 10, 20 years. It is the 5th largest economy and will be the 3rd largest in the next few years. My question is Berkshire actively looking for opportunities in the Indian equity market, and what will allow you to buy anything meaningful there? So I will skip what Warren has to say. It's not important. Just kidding. No, but the whole idea is Warren actually effectively said, listen, I don't know enough about India to invest, but my successors will be able to possibly invest. So that is really, that gave me the idea, oh, listen, and subsequent to this question, what happened is a lot of people reached out to me and they wanted to know about India and why India and how can you invest in India and what are the opportunities in India. And I said, if so many people are asking me that question, clearly there is an interest. And we said, let's have a conference like this where anybody can come and talk about India. And that's really why we set up the conference. So before I really get started with the conference or with what I had to present, I want to give out a few disclaimers. And these disclosures and disclaimers apply to all the presentations. It's not just for my presentation, so I want to ensure that everybody understands. First, all the information that we are presenting is only for information purposes. We are not selling anything, none of the sponsors are selling anything. The purpose is to make people aware. And that is why we are organizing the conference. The second thing is, DoorDarshi Advisors is the organizer, but we are not a broker-dealer. We are not representing any of the companies here. So please don't treat that we are representing or we are trying to sell anything. By the way, this is the slide which has the most words, so just bear with me. I want to ensure that we go through the disclosures so that there is no conflict. As I said, sponsors of the conference have paid for defraying the cost. We don't, as DoorDarshi Advisors, we have no relationship with any of the companies who are sponsored, right? Except for DoorDarshi India Fund, where, as Shuchi said, DoorDarshi Advisors is the general partner of the fund. We don't own either of the stocks, the sponsors, which is either ICICI Bank or ABDL. So again, we don't have even that way preference for the stock, but we may buy or sell in the future. So you should not treat not owning the stock as positive or negative. And then presentations that we are giving out today may have forward-looking statements, and please do not rely on them. Please do your own work. So I think the message is, please do your own diligence. Don't hold us accountable for anything, because we are not accountable for anything. You are accountable as individuals to making your own decisions and for whatever actions you take, right? So we are here presenting, giving out the information, and letting you make the decisions. Okay, so the agenda, I think we are running a little bit behind, maybe 15 minutes behind, so we will go on for a little bit extra as well. So the welcome and logistics is what we are currently doing. Then I will spend around 20-25 minutes talking about why India and why Indian equities. So setting the context, especially for people who don't know. I think there are a lot of people here who already know about India, but I want to set the context to ensure why we are so excited about India. Then we will have ICICI Bank, represented by Akshay. He will be presenting on ICICI Bank. And again, with every session, after every session, we will have opportunities for anybody here who want to ask questions. So feel free, there is a mic here, so you can just come here, you can come anytime, stand here, so the speakers will know that they can ask, that there is a question to be asked, right? After ICICI Bank, we will have Ashish Chauhan. Unfortunately, he is not able to travel, so we have his recorded message. So we will play. Ashish Chauhan is the Managing Director and CEO of National Stock Exchange. And so he will tell us about investing in India and how does he think about India versus the world. Then I will be coming in and talking about investing in India from a practitioner's perspective. So initially we were talking about why India and Indian equities from a global macro perspective. And subsequently I will be talking about from the fund perspective, from a practitioner perspective, as we are investing in India, what we are seeing from DoorDarshi India Fund. We will then have Alok Gupta. He will be talking about the evolving Indian consumer and how his company, ABDL, is able to tap into that opportunity that he is seeing from an evolving Indian consumer. Then we'll have Vikas Khemani. He's a fund manager. He runs Carnelian Asset Management. And then we will have some additional time for questions and answers, and we'll see how that goes, right? So we will see in terms of, and for every speaker, we will have slots for question and answer. So the time that I have given is for the presentation as well as for the Q&A. So I would recommend that everybody stops a few minutes before. That way we can ensure that we have some time for Q&A. Okay, so with that agenda, let's get started. So these are the speaker lineup. I just wanted to put the name and the faces together so you know who the speakers are, and there is no surprise there. Okay, so logistics, all the presentations are being recorded. So if you are present in the room, you are giving your permission to be recorded, right? So I don't want subsequently any surprises on that. We will try to maintain time. Obviously, we are running a little bit behind, so that's part of it. And if you have any question for the speaker, as I said, just please go to this particular microphone, and you can then we will know that you have questions. So with that, let's talk about case for India and Indian equities. And I know there are a lot of senior people here, people who understand India very well. So either in the question section, even if you don't have a question but have a comment, feel free to go to the mic and speak, so that way at least we can hear your perspective as well. So before I begin with my presentation, the first question: how to become the world's fastest swimmer? Anybody has an answer?
Hold your breath the longest.
Okay. What else? How do you become the world's fastest swimmer?
Practice.
Mm-hmm. Consistency, practice. Hold your breath. Anything else?
Good genetics.
Good genetics. Okay.
Sure.
Okay. What else?
What about swimming in a river that's going strongly in one direction?
You are my man. That's exactly right. Right? Swim with the tide. Right? You will be the fastest swimmer. That's exactly right. And that is what we are trying to do with investing. Right? We are trying to invest where the prospects are the best. And hence the case for India and Indian equities. why we are talking about India, because we think the prospects are good, and if you invest in India, of course the prospects will help you, and then your own investing will help you as well. I actually gave a lot of clues, but that's fine. This is that's good. Okay, so that's why we are talking about it. So let's talk about why India and why Indian equities. So GDP growth. So as you can see, in the last 10 years, in the last decade, India has grown around 5.7%, right? It was the second largest or second fastest large economy. And going forward in the next 5 years, and again, for all my presentations, all the slides, you will see where we have got the source from. So this is from Jefferies, and they are projecting that in the next 5 years, India will grow at 6.3%, which will be the fastest growing large economy, right? So by 2030, India is expected to be around $6.7 trillion for economy, far ahead of Japan and Germany, which India is projected to overtake in the next few years. Now, Motilal Oswal here says that between financial year 25 to financial year 47, and this is what is the Amrit Kal, right? India's economy will become from 4.1 trillion to $30 trillion. And that is a growth of 9.5% CAGR in dollar terms. What will drive this growth? Demographics is one big factor. So India's working population, which is in the age group of 25 to 64, there will be an addition of 179 million people in that working age population in the next, let's call it, 20 years, right? In the same period, you will see that China is actually going to have a reduction in the working age population of almost 103 million. And Europe will have 48 million people who will come out of the workforce. So clearly demographics of the rest of the world is not looking as good as compared to India. And this will be a big driver for the GDP growth that we are talking about. The third thing that we should remember is the leverage. Now when we look at the leverage, we are looking at the debt to GDP of the overall economy. And you can see that India not only is going to be fast growing, but it also has a very good debt to GDP, right? The debt to GDP in 2023 is, let's call it 175%. And when you look at UK, Japan, even China, US, I think they are much higher. So that gives India a lot of opportunity to be able to invest and grow itself. And this is not just true at the overall economy level, it is true at the individual company level. So corporate debt to GDP or corporate debt to equity has been the lowest for the last 15 years. And again, this is giving a lot of opportunities for the corporates to do capex, to be able to find opportunities and take advantage of those opportunities. Household debt to GDP is again something very positive, and this will allow the household to consume because they can leverage themselves up. So you can see the debt to GDP of the household is around 35%. Compare that to most other economies. Many times people would want to compare to China, around 61%, US is around 74%. And so again, the debt to GDP of household will allow Indian consumers to consume and therefore benefit from the growth of the economy. Formalization is another big driver. So you can see that in India's economy, what has happened, and again for people who don't understand, formalization is where people are reporting their income, paying taxes on their income and so on. In financial year 2012, by the way, when I refer to financial year here, it is from April of the previous year to March of that particular year. So in financial year 2012, we only had 31 million tax filers. And that has almost doubled, or more than doubled, to 80 million. And in the last few years, the formalization pace has slowed down a little bit, but clearly with the GST and many other drivers, that pace was going very well in the last decade, right? And it has more than doubled, 2.5 times. And formalization will allow more tax revenue for the government, and therefore that will allow the government to do more capex and grow the economy. Now coming to the companies, let's look at the return on capital. Right? The return on capital, return on equity of listed companies in India traditionally has been in the mid-teens. Let's call it between 12 to 16% is the return on equity. And again, that is very good because it allows the companies to sustain themselves and through that be able to grow without necessarily having to dilute again and again. And you would see that during the COVID years that ROE came down, but it has again gone up. If you then look at ROE of Indian companies vis-a-vis the world, what you will find is that Indian companies are among the best in terms of the high return on equity. Right? US is the only other country where the ROE is this high. And what that is telling you is that Indian companies pay a lot of attention to the capital and how they're consuming that capital. And it is a good place to invest in terms of the focus on capital efficiency. I talked about how much the growth will be, what that will translate into a massive savings potential for the Indian consumers. And so again, there is this projection that if Indian economy were to get to a 30 trillion by end of 2047 financial year, there will be almost a savings which will be around $126 trillion between now and 2047. And so that savings is going to be another big factor for why I continue to be so bullish. Let's look at another factor, which is how are the savings getting allocated. And what you will notice is the household savings in India, if you look at it, most of it goes into property, almost 50%. Another good 18%, am I correct? Or 15%. 15% goes into gold and 13% goes into deposits. So almost 75%, more than 75% of the Indian savings is going into these hard assets other than bank deposits. And only 6.9% is going into equities. But what is interesting is if you look in the last decade, the allocation to equities has gone up from 2.2% to 6.9%, 3 times in the last decade. And that trend has obviously grown a lot, but if you compare that to where India is vis-a-vis the other large economies, you will find that US has the household investments in equities is almost 40% of the total net worth, right? Or total wealth, versus India is around 7%. So you can see there is still a long way to go. And this trend, all the savings that we talked about, around 126 trillion in the next 20 years or 25 years, a lot of that will come into Indian equities. And that will allow the Indian equities, given the flow that we will see, that flow will drive Indian equities and the opportunities that we are talking about. A lot of people talk about Trump tariffs. So this is an analysis that was done. And assuming a 10% tariff on all non-commodity imports, India's GDP is likely to be impacted by only 16 basis points. China's actually, interestingly enough, here is only 10 basis points. But look at what is getting impacted the most, Mexico and then US, which is interesting. So it is that the Trump tariffs, at least in this analysis, does not seem to have as much of an impact. In fact, we think there's a decent upside with the Trump tariffs, and I will tell you why. First, India's economy is primarily domestically driven, right? And because India consumes a lot, produces a lot, there is less impact of import and export. Second thing, India and US are having this bilateral trade agreement that is going on. And you would have heard, many of you would have heard Trump talking about it, that India might be the first country where they will be able to address this. Scott Bessent has talked about it. And I think a bilateral trade agreement will actually help India, because in India's case, there is this desire to take the trade between India and US to $500 billion, which is around $200 billion. So as that happens, a lot more opportunities will open up for the country, for the companies in India to take advantage of the US market, which is a big market. The third thing is the free trade agreement that India is doing with various countries. Given all these issues that are going on, a lot of countries are interested in doing a free trade agreement with India. And we are talking with, or Indian government is talking with European Union, Middle East, and New Zealand, Australia, and so on. So I think free trade agreement will again allow Indian companies to do well in terms of the growth opportunities. Crude prices is another big factor. I mean, if you look at the crude prices, it's down to $60, right? And if you look at India, more than 85% of the crude is imported. And if the crude prices comes down, your fiscal situation goes up, because India can put taxes on the crude and not still lower the prices of crude. And the second thing is your forex import goes down. So both from a fiscal situation and the forex situation, it's a huge positive. And then from a fund manager like my perspective, it's good that INR does not keep depreciating like how it has been, right? So in the last few weeks, months, we have seen that INR has started appreciating, which is a good news. But maybe the 3 to 4% appreciation that we have seen historically would not be as bad going forward, and we will see a little lesser depreciation. I mean, one of the drivers of depreciation has been the big differential in the inflation rate between India and US, and obviously that has shrunk. And so one could argue that the depreciation rate for Indian rupee will come down, which will enable anybody who is investing in US into India to not be hurt as badly by the INR depreciation. Here I'm talking about a little bit about the historical returns. Many times I talk to people and they say, oh, you know what, the INR depreciation really kills the returns. What they don't realize is that if you look at the dollar returns, and that is ultimately what everybody has to look at who is based in the US, let's call it. If you look at any different time horizon, 5 years, 10 years, 15 years, 20 years, you will be surprised at how well BSE 500, I'm not even talking about a mid cap, small cap, large cap, all that I'm not even talking about. I'm talking about BSE 500, right, which is the top 500 companies in India. You can see, and again, this is slightly based on when you have taken this particular data point, and this was taken in, so again, this is from Jefferies in September 6, 2024, so there is a little bit of that element of when you have taken this data point. But you know, if you're looking at a 20-year horizon, you know, 6 months of up or down of the market will not dramatically change these returns. And my point here is, across various different time horizons, India's equity have delivered a double-digit return in dollar terms, accounting for the INR depreciation that I was talking about. So therefore, and again, you can look at how many other countries, stock exchanges have delivered similar returns, and it is not that many. And so again, if I look at historically even, these countries have delivered very poor returns as compared to India. So India, Indonesia, Taiwan, and S&P 500. And S&P 500 is a good benchmark to have for obviously the US investors. And then you can see that in different time periods, these top 4 economies have done well, or top 4 equity markets have done well compared to many of the others. China is around 7% in 20 years, right? So China has not done as well. And I think this historical return, in my mind, should continue in the future as well. If anything, would even accelerate. And I talked about why it would accelerate given the good economic situation that India is seeing. Another factor that people talk about is the valuations, and Indian valuations expensive. So I'm talking about a few different valuations here. This is Nifty 50. You can see that the forward price to earnings, 1 year forward price to earnings is around the median, which is around 20 times, right? So it's not that expensive. Nifty mid cap is again around the median, but we should realize that the Nifty mid cap is expensive. It's around 35 times earnings. So one has to be careful when you're investing. You cannot really just take an index and invest in that index, clearly. Nifty small cap, it's not as expensive as mid cap, but still not cheap either. But it is around the median as well. So I think small cap and mid cap are around the median, though the median is not cheap. And Nifty 50 is around the median or lower than the median, and it's at a reasonable valuation, I would say. So what are some of the risks with India? And obviously I cannot talk about only good things. Let's talk about some of the risks. One of the risks is last year in 2024, there was a lot of new supply that came into the equity market, in the sense of a lot of new stocks were offered in terms of initial public offering, follow-on public offering, as well as QIP. And so that accounted for almost 3.3% of the market cap. And that is, as you can see, there have been various years where we have seen so much of supply, but that's a big supply. And what that has done, if you look at it in terms of how the supply was allocated out, you will notice that total equity offerings was around 6 trillion. Mutual funds, the domestic investors bought around 4.3 trillion. And then we had FPIs buying around 1.2 trillion. So what effectively has happened is that FPIs have sold a big amount in the secondary market. And that is where it has come down to 1.3 trillion was sold, 1.2 was bought. So there was a net flattish for the FPI. But a lot of money was taken out of the secondary market from an FPI perspective. The second risk in Indian equity market is the weak earnings. So we have seen in financial year 25, the earnings were quite weak. The first 2 quarters were negative in terms of a year-on-year growth. Third quarter has been positive, but mid-single digits, right? And the fourth quarter, we will see mid to high single digit is what we expect. So let me list down what are the risks. So the key risks are, one is the fracturing of the international trade and what it will have and its impact on India. Our view is that if anything, India might become better positioned because India gets into to the various supply chains that it is not right now. The second thing, which I did not talk about, but we should talk about clearly, is AI and what that will do to the demographic dividend that I talked about earlier. Because it is possible that AI takes care of many of the jobs and you don't really have a demographic dividend. My take on that is that India still has a young population, right? India's population median age is around 28, 29 years. And therefore, Indians, especially these young cohorts, are able to imbibe the technology very quickly. And this is obviously not necessarily the only message here. We have to look at what will happen, how the Indians will be able to take this technology, the AI, and how they will be able to manage going forward. The third thing, I already talked about, Indian equity markets are expensive, and they are expensive versus the world. But I would say that they are, first of all, at median valuations. And second thing I will say is that Indian equity markets and Indian equities are likely to grow at a faster rate. And if they are going to grow at a faster rate, then one would expect a higher value. And the fourth thing, which I put recently, given what is happening in India and Pakistan and all the good stuff, is the challenges in the neighborhood. It is a risk in the short term, definitely, because we don't know what will develop there. But if you look at in the last 5-10 years, the incidence of terrorism has gone down. And frankly, a strong response is likely to reduce the probability of such issues in the future. Okay, so summarizing my Indian opportunity, I think India has a long runway to grow due to demographics and a low base. A lot of reforms have happened, which has enabled strong balance sheet in terms of corporate, bank, and household, and that should enable India to grow well in the future. Government has, and I did not talk too much about it, but government capital expenditure has enabled a lot of good investments, and this is also crowding in investment. And one good thing is when government spends on capital expenditure, it has a much better multiplier effect, right? So typically, that multiplier effect will allow the economy to do much better in the future. So given all that, I expect India's GDP to grow at 6 to 7% with a nominal GDP around 10%. And you saw earlier where we had a graph where we said 9.5%. So it is very likely that if you can find good companies, 10 to 15% is a reasonable expectation in the foreseeable future. All of this will translate into high domestic savings, which I talked about. Last year, there was almost $30 billion worth of investment that came into the Indian equity market, which was able to offset most of the pullback that we saw from the FPI investors that we saw last year. So just like in the last few decades, which I showed you, I expect the next few decades to be one of the Indian equities to be one of the best performing asset classes. And that is why we are here talking about India and Indian equities. So with that, I will stop. If there are any questions, happy to take that. Otherwise, we'll move on to the next session.
Hello. All right. I was hoping you could maybe elaborate more on just the domestic population being under-indexed to equities and just the dynamics of, how that. I know you talked about the GDP growth and that funneling into the more savings in equities there, but I just was hoping maybe you can just elaborate on this. And then, is there any psychological maybe biases or whatnot where allocations wouldn't go into equities or anything that hindering that or impediments there? Thank you.
One of the interesting challenges that India has is the population pyramid is not necessarily very good right now, in the sense of the bottom 50 to 75% are not as well educated, right? And so the challenge India has is how do you educate them? And one of the big opportunities India has, in my mind, is that as technology becomes available to everybody. One of the earlier issues was we do not have enough resources to take the technology or the knowledge to everybody. And I think that has changed quite dramatically in the last 5-10 years as smartphone is now available to almost everybody. So all the knowledge of the world is now available to all these people. And so I think that is a big positive in terms of becoming more proficient and being able to leverage the technology, right? I think what still remains to be seen is how will you create enough of those jobs, because the population size is big. And we are seeing all types of jobs being created in India, from a low-end job like food delivery, right, which is actually a great way for Indians to get the job but also benefit from the growth. And I think from that to the top end jobs, which is the AI jobs, and learning and being able to deliver on those jobs. So I personally am of the view that given the growth in the demographics and therefore the people, we should be able to, or India should be able to use that population in a very productive manner, because there are so many other types of jobs that are opening up which were earlier not available. Does it answer your question?
Yeah.
Okay.
The biggest problem, in my opinion, facing the U.S. economy today has its roots in wealth and income inequality in the United States. What is wealth and income inequality in India like in comparison? And are there any legislation pending or anticipated to reduce wealth and income inequality in India?
Indian inequality, what I would assume, is even higher than in the US. Right? If you look at the richest person in India versus the poorest person, poorest person is hardly able to survive, right, in India, versus the richest person would be really rich, right? So the income inequality is definitely an issue. But the issue of income inequality is because there was not enough opportunities for people, what I was talking about earlier. What is happening now is there's more such opportunities that are opening up. And to me, as those opportunities open up, that will create more opportunities for people to move up the ladder. So one of the things that you might have noticed, or I don't know how closely you follow India, there is a lot of entrepreneurial activity that is going on. A lot of entrepreneurs are coming up. There are more than 100 unicorns. And these are people who did not have any business earlier. So what is happening is people are now realizing that I can start something from ground up and be able to do very well over time. And once you have role models, then other people can follow on that. And so what we are finding is there is a dynamism to the economy. There is a lot of opportunities that people are seeing, and therefore there is a lot of energy that is there in the populace in terms of being able to do well. So therefore, I think yes, income inequality is there, but frankly, that is also creating a lot more motivation for people to work hard and do better for themselves and their kids and so on. And I think that, in my mind, is actually a big positive. If everybody has the opportunity to move up the ladder, and that's what is happening.
Are you aware of any, what I would call federal legislation concerning minimum wage,
Yeah.
living?
So Indian government has been distributing free ration to the bottom of the pyramid. So there are two things. Indian government gives out a certain amount of money every month to people who are basically self-employed but don't really have any work per se, like 2,000. It's a very small amount, but they also give a lot of free ration. And that is good because it enables people to sustain themselves. They're not dying of hunger, let's call it, right? But that does not give you a good living. And if you ask me, I would prefer not to have a legislation like that, because that legislation, what it will make is, it will create a welfare society. You don't want to have a welfare society where you're just doing good for the people, where people are not working. So there are a lot of schemes the government have. They say, listen, if you do work, we'll pay you a certain amount. And I think a lot of societies, once they are rich, they move to a situation where they say, no matter what you do, we'll pay you a certain amount. Unfortunately, there is no incentive for people to work. And I think Indian government, and I actually am conflicted on that, you want to ensure that people are not dying of hunger, but at the same time, you want to incentivize people to do well. And so right now, I think there are various policies the government has which addresses that issue, and I would prefer that it stays that way, because that will allow the people to actually do work and do well for themselves.
Well, thank you so much for the session. It was really informative. My question is also related to demographics. So majority of Indians right now, majority of the population lives in rural areas. And a lot of the population growth that's going to come is probably going to be mostly in those rural areas. So even though we spoke about AI and how smartphones and technology will create those opportunities for the larger working population, do you think the Indian government or the Indian economy has the capability to build the required infrastructure for the new population to get jobs given AI? Because in rural India, we do see a lack of roads, healthcare, education. So do you think the Indian government or the Indian economy is capable of supporting the growing population within?
So I think a lot of this will not just fall on the government, in my mind. Government will not be able to support everything. And that is where a lot of the private participation, in my mind, is so much better. Because private participation has better metrics. It will allow the private parties to say, if I'm spending this money, how is it being used? Versus government expenditure where the money is spent and the outcomes are not necessarily as good, right? I think AI and its challenges, frankly, at this point, nobody can say how that will play out. But if I just look at the dynamism, I feel good, because one of the things that will happen is a lot of people will migrate from rural to urban areas, because that is where the opportunities are. And again, in terms of the infrastructure, I think what government should focus on, in my mind, is the hard infrastructure, the roads, railways, airports, ports, whatever stuff like that. And I think government, I don't stay in India, but I travel India often enough, and I can see the difference whenever I go from time to time. The roads have become a lot better, right? I think railways, you look at the stations earlier versus what they are now, I feel like they are making a significant change to that. And also India is moving into these new industries, new technologies. And I think so, therefore I feel good about it. Can they do more? Absolutely. Should they do more? Absolutely. But I think we are on a good trajectory in terms of growth.
Okay, thank you.
Hello Rajeev ji, my name is Vatsal. I work with Ken at Ridgewood Investments. We're also based out of New Jersey. Thank you for doing an event like this, because I strongly feel that in the coming years, India will be a separate asset class for US investors. I don't know if this was covered in your presentation, but I wanted to ask are there any particular themes in India that really excite you, like perhaps Global Capability Center or China Plus One, or like any similar themes you can talk about, and where you see the underlying growth?
So I think my opinion is India will grow across most of the sectors because of the deficit that we have, right? So I think any sector that you take, I think there will be growth. And on top of that, what you have to find is growth is there, but how are the valuations in terms of investment opportunities, right? And that is where it becomes interesting and challenging. And what I will do is cover that in my second presentation. Is that good?
Awesome, thank you.
Testing, million one.
Yeah.
Okay. Thank you for the presentation. That was fantastic. You outlined the India growth story very well, so that's fantastic. So earnings will grow at that rate. The ROE chart you had shown, which was 16% per year. What is the historical return on equity has been for Indian stock markets?
So that's what I showed in one of the charts where you saw for different years, and it did dip quite a bit during COVID. Do you want me to pick the chart up again? Oh, you're talking about the average, or you're talking about
ROEs for Indian stock market?
Yeah, ROEs for Indian stock market is this one. ROE of listed companies, right? From 2001 onwards till 2025. So it has varied, you can say on an average, between 10 and 15% is a reasonable thing. Sometimes a little higher than 15%, sometimes a little lower than 15%.
Okay. That probably, US stock markets have performed around 10% because the ROEs have been around that ballpark. But then you are saying EPS will grow, 10 to 15%. So I'm just thinking, assuming multiples don't change, it should be mid double digits. The returns for
I think that is a reasonable expectation, because when you're talking about a 10% INR growth rate for the economy, then that means that on an average a company is growing at that growth rate from a salary or from a revenue perspective. And then assuming that you don't have unreasonable competition, I think the ROE of around 15% plus minus is a reasonable prospect, I would think. And in that case, you would not have to dilute anything, because the growth rate is all being funded through the capital accumulation that you are having over years, and therefore similar sort of a earnings growth is very likely.
And for this, you're paying a multiple of what are we paying right now?
So in Nifty 50 is around 40 times, mid cap is 35 times, and small cap is around 25 times. And so the one thing I will say to that is markets, when markets are trading there are a lot of variations in those indices. And so one has to, so one of the things I will talk about later in my presentation, in my fund presentation, is if you invest in an index, it's a little bit harder to do very well. But if you are so therefore India is a stock pickers market, where if you find good stocks, good opportunities, one can do very well. But buying an index, and you might know this, that Indian ETFs in the US have not done as well comparatively. And one of that is because the valuations are never cheap, especially if you're buying those big name indices. And so you need to be much more looking at individual stocks and identifying opportunities. But even there, I would expect you have seen how BSE 500 did around 13% over 20 years.
Yeah.
that is a reasonable expected growth rate. There is no reason why that should change that much.
So with the tide, yeah.
Yeah.
Thank you.
Yeah, hi. You mentioned in one of your slides that household asset allocation, the equity component of it is very low.
Yeah.
It's on the rise, and you also mentioned like when we compare the amount of population taking part in the stock market compared to other countries, that's also quite low for an emerging country like India. And with the tailwinds that we have, such as rising workforce and all, so would you say that firstly that this particular theme is underlooked, and B, could an increase in inflows, because that's what we're seeing, could actually kind of revert the mean multiple of Nifty's or the stock market index and take it a bit higher than what it has been historically? Let's say 18-20 as trade flows increase and businesses become more efficient and the market recognizes that. Thank you.
Yeah, and that's a great question. I think inflows will, in the short term, create a demand-supply mismatch, right? Either both on the demand side or the supply side. But what we have seen in 2024, as you saw in the presentation, is as there is more inflow, there is also more offerings, right? So it is not. So I don't expect a situation where if there is much higher multiples, more companies will come to the market because they will get better valuations. And so I think there will be enough offerings that will come through. And really, ultimately, why will the multiples be higher? If and only if the investors make good money, right? That is when you will actually be willing to put in the money. And we have seen that India has delivered well. Now, unless India's growth rate expands dramatically, right, and ROE and what Vishal was talking about earlier, there is no reason for me to believe that it will change dramatically at the indices level, because ultimately more money will come in means more offerings will come in, and therefore that will balance out in my mind. And I think in the short term, definitely multiples can expand because of demand-supply mismatch. But over the long run, I don't think that is a sustainable high multiple. Like, we cannot say India is going to be on a sustainable high multiple trajectory, because then the investors will not get adequate returns.
Thank you. And a quick follow-up to the same.
Yeah.
As we discussed India, you talked about themes like, for example, infrastructure spending, capex spending, government coming in, the consumer cycle taking in. Would you say that this perhaps the AMC theme is also a theme which is like too big that perhaps media hubs are missing out on? Is there a significant opportunity for these banks or financial institutions to kind of cross-sell their existing clients and kind of, as we saw there was a problem in deposits recently, the banking industry kind of, take it to the next level?
Yeah, I think financialization overall is a big theme in India. As you would know, in India, in general, and you saw that household savings chart, you can see that we don't have enough financial products, right? There are a lot of savings goes into real assets. And so I think as people realize that the returns that one can get, either through AMC or through their own investments or through distribution, whatever it is, everybody is looking for better returns, no question about it, right? And so if you can find better returns in financial instruments like equities, for example, or some other forms, then that is where the money will flow. And so I would assume that this money flow into equity markets and financialization is something which is a very long-term theme. And that theme is going to get further and reinforced because people are becoming more aware of these. In the past, that awareness was lacking. But as the returns have been delivered, people say, okay, there's a possibility for me to do better. And I think they will definitely move from that side.
Thank you so much.
Sure.
That was a great presentation. You talked a lot about equities. What about the bond market? And in that connection, the monetary policy in India, how do you see the prospects of that with reference to interest rates and therefore the bond market?
Right. Thanks, Nishkam. So, in terms of the monetary policy, I think India's interest rate will over time come down. And why they will come down is because the inflation rate will come down over time. Now, I was mentioning in the previous session that on average, India's inflation rate was much higher in the previous years. But now RBI is targeting between 2 to 6% inflation with an average of 4%. And therefore, over time, we would expect that India's interest rate will be a little bit over that, whatever the real interest rate should be. But it will not be as high as it is. And therefore, one would assume that over time, bond markets will do better as the interest rates come down. So if you're investing in the bonds, you will do better. I mean, they will get that. I also think that in India, like in any other place, when you're investing in the bond market, it's a negative art, right? You first figure out what you should not own, and then you decide what you want to own. Versus in equities, where you're focusing more on what you want to own, right? And so I'm not much of a bond guy, which is why I did not talk too much about the bonds. But in terms of the broader trend, I agree with where the gist of your question was going, which is bonds should also do well, but that is not something that I track too much on.
Hi Rajeev, amazing presentation, but so far it's been about India's story. I was waiting for the fund information. I'll wait for the later. But in this I had a couple of questions. Pardon me if it is basic. We have looked at the past 20 years on demographics, equity growth, whatever, on India. But you did mention about dollar to rupee ratio. It might be useful to look at that as well in a progression of 20 years, because end of the day, what you're putting, what you're taking back is dollar.
So this
So-
one I think is...
Yeah, what I was trying to get at is like, when we look at the growth rate with respect to dollar appreciation, when we look at comparison between S&P versus what we have in India, that's the way I look at it. Like if I have two options here, being in US, I can invest in S&P, SPY, for example, and get done with it, compared to, you might be a good stock picker, but I just want to look at how you're looking at India's growth with respect to US.
Yeah, so India's growth, I think, as we said, 6 to 7%, right, is the real GDP growth. And if you assume from a dollar perspective, I think you would want to do a dollar to dollar comparison, right? And if you do a dollar to dollar comparison, 6 to 7% real growth, and you assume US inflation to be 2 to 3%, I think that's a reasonable. So you can assume that India's growth rate in dollar terms will be between 8 to 10%. We are adding the real GDP and then the dollar inflation effectively to come up with that. You can do the reverse as well, which is to say, I will look at the real GDP growth rate, and you will add India's inflation to come up with the nominal GDP growth rate. And then you say, what is the INR depreciation? And you can come up with the same thing. In one of the slides, I did mention that India's growth rate there was projected by Motilal Oswal as 9.5% CAGR in dollar terms. Right? So I think that is sort of the growth rate that you would assume. I think between, let's say between 8 to 12%, keep it wide, is what I think is the reasonable dollar growth rate for India, right? And then you compare that to what you will have in the US, and again, it will depend on what the real rate and what the real GDP growth rate and what the inflation is. But again, if inflation is 2% and the real GDP growth rate is, let's say, 1 to 3%, you can just add that up and you will get your dollar.
Right. So if you look at INR versus US USD in the past 15 years or so, it's probably gone down initially, like 40s went to 30s and then came back like crazy. Now it has everyone was at 85. So in terms of like 2 or 3 times of increase of the currency itself, are you looking at that as a backdrop when you are investing your funds?
Yes, absolutely. Yeah, so if you hold that question for the next presentation of mine, where I will talk about the fund.
Absolutely.
And because that question I get a lot, which is Indian rupee has depreciated so much.
Yeah, and I continue to think it will depreciate more and more and more, because how much how much we are playing with the currency versus advanced countries makes a importance. Okay, we can defer.
But I will just tell you this, right? So this is India's BSE 500 index growth in dollar terms. So this accounts for the INR depreciation, right? And even with that accounting of the INR depreciation, you will notice that India's index in dollar terms has done better than SLP.
Well, I do disclaim this by the past couple of years of rapid growth.
Yes, yes. I would not disagree.
Okay, moving on, couple of small questions. You mentioned about demographics in the next few years.
Yeah.
Demographics versus population that actually can make money for the country would be slightly different, especially with India. Hopefully it's not going to be the same as what we see. It'll be better, but I'm thinking we cannot go by demographics as is, just like that, without taking more consideration. Second is about companies in India and the transparencies that they have. With the way we have in terms of familial companies, and they pass it on to their son or daughter or whatever. So it becomes really difficult to take the plants from the weeds, but I would differ for that from the fund perspective. That's all.
Okay. So maybe you can repeat these questions.